Hello once again, everybody. Kevin Shortell here with Mr. Eddie Speed. Eddie, how are you today?
I am great, Kevin. How are you?
I'm good. I'm looking forward to part two of this, and we had a lot of information on part one of what's a note worth, and today is part two. And once again, everybody, it's such a fundamental skill in this business. If you don't have it, you're not going to be as effective in this business. You're going to leave a lot of money on the table. It's that important to do this the right way. So, Eddie, why don't you start us off with a quick recap of what we talked about in part one?
All right, so on part one, Kevin, we went through the 6 variables that influence the value of a note, okay? And we uncovered some examples of 4 of these 6 variables. So there's 2 that we didn't get to yet. All right. Now we're going to go back and revisit some of the things that we talked about as far as the terms of a note and pricing and that kind of thing. But we got at least through some foundational principles. We said there's 6 characteristics that influence the value of a note: the buyer, the collateral, the buyer's equity, the terms of the loan, the pay history, how long it's paid and how well it's paid, and then also the paperwork. So, and one thing that we're going to take a good long deep dive into, Kevin, this time, and it's this magic question. And that question is, what's my yield, right?
What's my return?
What is yield anyway, Kevin?
Right. We always think in terms of that as return on investment. If you want to break it down to its most simplistic term, I would say that would be it. And what kind of return are you getting on an annualized basis is what we look at for the yield.
Think of it like this: yield is nothing more than the interest I earn on my investment per year.
There you go. I like that too.
Yeah. Okay, Mr. Shortell, pay history. Pay history. And
go ahead.
Why is it so important?
Well, again, on part one, we introduced that term seasoning. That may not be a new term for everybody, but certainly some people on this webinar are seasoning. It's kind of their track record, right? How much have they been paying? Have they been paying on time? And again, if we're going back to your analogy of cooking a pie, will everybody even have a payment history is probably another question, right?
Yeah, there's no doubt. I mean, I've bought thousands of notes, literally thousands of notes, probably more like tens of thousands of notes, where people I didn't have all the financials, I didn't have all of the picture, and worse than that, they had injured credit on their credit report. And you're going, how can you live with that investment? And the answer is, I can live with that investment by one simple way, and the way I can do that is because they got pay history. I mean, when a guy's paid 3 years or 4 years on a note, it scrubs away a lot of other undesirable credit issues. So then you get into, as what we refer to, the big factor, and that is it's the redeeming factor when they either you have a weak buyer, meaning they have a weak credit report. I don't mean that, I'm not making a personal judgment about them. Their credit report really is their report card, is how they paid other creditors, right?
Right.
And then also it can be a weaker collateral, not every property is the same, and sometimes there's properties that just, it's just not the prettiest place in the world. It doesn't mean it's all dilapidated and fell in, but what do you do when there's a 20-year-old mobile home out there on a little piece of land out in the country, right? It's right. Some people go, well, I would never touch that, and I'm like, I don't know. Show me a pay history. And I'll tell you whether I'd touch it or not, because sometimes that's just where they live. It may not be where you and I would necessarily move, Kevin, but that's where they live, and there's nothing wrong with that.
Right. I believe on part one you were talking about the neighborhood and the fact that you would purchase some things in neighborhoods where other people might not do that, or maybe there's a train coming right down the the back of the house and that sort of thing. So but you're saying here with the payment history shows, look, they've been here, they've been making payments, they live here, they have a tolerance for that, and based on that history, they're going to continue to do so, especially with the rent today in a lot of these areas. Would you agree, where the rents have gone up so much in some areas, boy, they're highly motivated to stay where they are and make those payments.
We see most of the working class notes we see, Kevin, if they stop paying on their house and they had to just go pay rent, their payment from their mortgage payment to pay back the loan that we're buying versus paying rent on a new house, their monthly payment would double.
Yeah, so you're saying they can't afford to rent next door, essentially.
You got it. I mean, they're paying $500 on a mortgage, and it would cost $1,000 to rent it. So, you know, and it's funny, Kevin, you and I are so used to doing this and seeing examples because it's what we live in all day, every day. I forget sometimes that some people come to Note School, they've never, that's like, they're like, wow, I had never seen a deal like that.
Right.
Well, let me tell you something, in about 20 states, that's the truth.
Yeah, Midwest, Southeast, and
may not be true in you know, Orange County, California. Of course, we have as many students in Orange County, California as anywhere, just because, I'm just saying that because it's a high-income area,
right?
A high-dollar area. Well, I mean, they figure out they can do this business anywhere in the country, and they're like, I like where I live, but you know, I can make some incredible value buys in other markets. So wherever you live, or however that ever relates to you as you progress, you'll learn that this value add, this value argument that we make over and over and over is just, we're in a pretty incredible market right now because of that. So here's what I would say, Kevin. They have poor credit, but they've got this. What is this, Kevin?
Right, so your 100% means they're making 100% of their payment.
You look at the calendar, and they're making 100% of their payment every month as agreed, and that good pay history will override what's above it, which is maybe they've had some injured credit. And do you think, Kevin, that could be true, that a lot of people have been foreclosed in the past, had issues in the downturn of the economy, now all of a sudden they've been paying on a note for 2 or 3 years and got a good pay history, they've gotten their job back reestablished?
Right, exactly. I was just thinking the same thing, and I was wondering, I bet we could pull a number to find out how many millions of people that case scenario you just said applies to today.
They're not bad people. It's just something bad happened to them.
Right.
So that pay history, in my mind, is everything, because it is their redeeming factor in light of poor credit. Okay? So I'm looking at a performing note. This note cost 60 to 90 cents on the dollar in the secondary market. Okay? Now the magic, Mr. Shortell, is when do you pay 60 and when do you pay 90?
There you go.
Now we'd all love to pay 60 every time, wouldn't we?
I'd like to pay less every time if I could, right?
Sure. Well, let me tell you a sad fact. You're gonna get left out of a lot of invitations to play in somebody else's sandbox.
Wait a minute. The industry doesn't adapt to me? Hang on a second. Is that what you're saying?
Yeah, that's what I'm saying. You and I have written the rules, and the industry said, no, we operate with our rules, and you just got to learn what the industry rules are. I think that's what a lot of Note School teaches, by the way. We teach people what are industry standards, because whatever they think, whatever rules they make up doesn't necessarily mean the industry is going to live with it.
That's right.
So if we buy an unseasoned note with poor credit, and that note was written at 9% interest, payable over 30 years, okay, this is the note, right?
Mm-hmm.
Then I'm going to receive that future cash flow of $804 a month, right? So I'm buying an unseasoned note, meaning a note with no pay history. Oops, and they got poor credit. All right? So the poor credit factor means that if the day I buy this note, there's an element of risk of default, and I need to understand what that is. So I'm going to say, let's say that in this analogy, I'm buying a note with no pay history, poor credit, and Kevin, let's just assume for a moment they don't have a lot down. They only got 5% down or something, right?
Okay, so the house sold for $105,000. They put $5,000 down, got a $100,000 note at 9%.
The note buyer needs to understand that you're taking the risk of delinquency and default for the next 30 years on that loan. And that next 30 years is very different as far as what the percentages of default are. So in month 6, it's very different than month 36. Does that make sense, Kevin?
Sure.
Okay, so let's break that up and talk about what that really means. So let's just bust this loan up into what the first 2 years, because that is a significant breaking point statistically in the performance of this loan. Now remember, Kevin, this is a transaction where a guy with seriously injured credit owns the money, and he doesn't have a lot of skin in the game. He doesn't have a lot of down payment.
Right.
So in the first 2 years, there's a 20+% chance of default. How about them cookies?
Yeah. Now, I'm sure some people are looking at that. And how did you come up with those numbers, and how did you come up with that time frame?
Well, I am very close with the people that service the most types of loans like this in the country, and based on servicing records, this is a proven statistic.
Mm-hmm.
So now you understand, Kevin, why if I'm buying somebody's note, I may not say the pie's baked well enough yet.
Right.
Because they've already created a transaction, they're trying to sell it to me, and I'm like, whoa, wait. This loan will get good, but it's not good yet, because it hasn't established that pay history that overrides that poor credit. So if I can eliminate this problem, Kevin, meaning that I buy a loan after it's got a 2-year pay history, then with a 2-year track record, then the odds on the back 28 years of that note, well, it has a 5 or 6% chance of default.
Just drastically reduced.
Crazy difference. Kevin, I would say that literally 98, 99% of everybody that's associated with the note industry does not understand this.
Mm-hmm.
Because, I mean, you and I have taught it, preached it, everybody on my executive team, I mean, we've been through this a million times, and I am shocked at how many people don't understand why I can buy a loan with the payer has poor credit. And it's because that pay history for 2 years, that first 2 years is risky, and past that, then it starts becoming better and better measurable degree. And 5 or 6% actually is a liberal number, Kevin. It's probably 3 to 4.
Right, and those are just percentages, and you can't blame people for not knowing this who are in the industry, because it's not a number that a lot of people would even know how to get and know how to understand that. And I think that goes back to what you were saying with not only yourself but your executive team and coaches with the experience levels and being able to look at this from a whole different eye set. I mean, I think if everybody knew this, they would change the way they approach these, but they just don't, because they don't know what to look for. You think that's accurate?
Yeah, we don't know what we don't know, or we haven't seen what we haven't seen. I mean, we've spent our career in the deep dive of the note buying business, and then buying these notes and experiencing how they pay and stuff like that. And so once again, unless somebody's had our experience, they couldn't necessarily quote these results. And so we're trying to give them the leverage. They don't have to have been in it 30-something years. They just rely on us who has been in it 30-something years, and we can fast forward what they know how to do. Here's the bottom line, Kevin. It's redeeming factors. The redeeming factor in our business, in this case, in this analogy, is the pay history. Okay? So let's go back and let's take an analogy. Okay, I've got a guy with a house with not a lot of down payment, and he has injured credit, poor credit, right? Not good at all. Okay? A brand new note, if I bought that note with no pay history, I would probably be somewhere in the 50% range. Okay?
So you're not even thinking yield here, right? Because everybody gets so yield driven. You're thinking ITV first. Why?
Well, because once again, if he's got a 20% chance of default, what if I'm in that 20? Right? So I have to price it, assuming, calculating the odds of default. Now, Kevin, if I'm buying 200 loans, that number could be a little different because I can spread my risk over 200 loans. Okay. If I'm buying a note, how many loans can I spread my risk over?
There you go. Just that one. So you got to protect yourself first.
Right. Now, so here comes the redeeming factor. 24-month pay history. You like how that happens there, Kevin?
There you go, huh?
Magic, isn't it? All right, so the investment to value in that scenario, I'll probably be at 75%. So once again, the pay history definitely changes the length of my yardstick and the exposure that I could take relative to what the house is worth, my investment to value ratio.
So 24 months of that payment history added that much value to that particular note.
That is the world of note buying. It's what we've done now. I mean, it's our career. I mean, it's what this is. If you're dealing in the space where the big players operate, this is the cardinal rule. That analogy I just taught there, that is the cardinal rule. And so here's the good news, Kevin. Everybody that's learning this understands how the big guys play, what the rules that they play by. Okay. Next rule, Mr. Shortell.
Paperwork.
Yes, sir. So I couldn't say enough about homemade versus homogeneous. Okay, and I buy a lot of paper that is not very homogeneous. I wish it were, but it's not, and so that gets into that pie baking thing, right, that we talk about, and sometimes I had to have it seasoned for a while, but it is what it is. The homemade side of the business is, here's the first question. You have to check yes in this blank, Kevin. You have to buy a loan that is a valid lien and it's compliant. That you have to do. Okay? So it is very important to understand that I can't go out and buy loans that were illegally made or that are not a valid lien on property. So you can't be half pregnant here, right? You got to be good.
Yeah.
And the second thing is, this is a Dodd-Frank term. You know Mr. Dodd and Frank, don't you, Mr. Shortell?
Yeah, I indeed do.
There's a term called a qualified mortgage, and that is, there's rules that apply to Dodd-Frank loans that are subject to Dodd-Frank, and we buy a lot of loans that aren't necessarily subject to the Dodd-Frank underwriting because they were created before Dodd-Frank, right? But if you buy a loan that's subject to Dodd-Frank, either the customer or the timeline that it became into effect, then there's a qualified mortgage and a non-qualified mortgage, and we could take a deeper dive on all of this, but these are definitely questions that you would ask. And here's another paperwork issue. What kind of credit file do you have? Right? Do you have a full doc loan, or do you not have a full doc loan? And so, doesn't mean that I can't buy it. It just means that it's kind of a measuring stick that I have to consider as part of the equation. Another paperwork issue is, do you have an appraisal on the collateral?
Mm-hmm.
You know, and you're an old appraiser. And Kevin, if I ordered a full-blown appraisal on a house that I'm buying a note on, the customer has been making payments for 30 months already, can I really go get a full appraisal?
Sure.
Well, you're an old appraiser. Go knock on some old boy's door that's living in a house now for 2.5 years, and ask him, you can come in and do an appraisal on it.
Right. Yeah. Going inside is going to be a different story. Sure. It's not. Yeah. Absolutely.
So that's, you know, there's sometimes a practical scenarios that means that you're not going to have everything here all at one time. So we're trying to measure all the possibilities, and then we're trying to give you practical application of us saying, okay, what if it doesn't have this? Can you still live with it? Because that's what our world looks like every day.
Yeah, that's that imperfection again, and I know there's probably some people listening and watching this webinar and going, okay, I followed you on a lot of this, but how am I supposed to know if a lien is valid? How am I supposed to know if it's compliant, and how do I look at a credit file? And I know that could be a very lengthy answer, but give us your short version of that. How do we overcome some of those issues?
Well, first of all, when we sell a loan to an investor, we want the investor to have it serviced with a licensed servicer, okay? And then secondly, if the loan is subject to this compliance, then it really has to go back to who you're sourcing the loans from. And we are very particular. We are like really, really particular about this kind of stuff. So, and there are other sources that you can buy loans that aren't as particular, and we're making it a point. Does that make it an advantage in dealing with us? Yeah, it probably does, but it's true.
Yeah. So you do this is your due diligence, right? This is your due diligence, and then you look at that, you look at what the problems are, and then of course you learn how to protect yourself on some of these issues as well, right?
Exactly. Anything that we talk about in all this, clearly, you know, you can take any one of these slides and do a deeper dive into any one of these issues, and you know, and obviously that's what, you know, NoteSchool does all the time, right?
Mm-hmm.
Okay, so protections, and what do we mean by protections? Well, what does the documents protect you with? Like the documents themselves. Do they require that the buyer has insurance? They require that the taxes had to be paid. Do they require that they're taking care of the property? So any one of these variables are protections that will be provided within the documentation. And if you have poorly written documentation, it may not provide for those things. That's the point.
Mm-hmm.
Okay, let's move on here. We got a buyer and his house, and then we have the mortgage lender that holds the note. The mortgage lender holds the note, and the house has a mortgage against it. Okay? So then you get into the variables of the buyer and the documented qualifications. Okay? Which is exactly what we said. Is the mortgage valid against the property? Is it compliant? Is it standard, or let's just say unusual? What about insurance, and what about taxes? So that kind of, if we kind of do a diagram here, Kevin, these are the different areas in the transaction. You've got your buyer and the documents on, you know, documentation related to their qualifications. You've got the house itself. Do you have a valid lien, and what does it provide for in the lien itself as far as proof of taxes, proof of insurance? and then you have the lender, and that is, did they complete it compliantly, and what degree of documentation did they use? And I've bought loans that were written on unusual documentation. It doesn't mean it was illegal or invalid.
Mm-hmm.
So that's really the art of the deal. Can it affect the price of the loan a little bit? Yeah, it can.
So you've got due diligence, and then you've got to learn how to manage this process, right?
No doubt about it. No doubt about it. All right, so going backwards, I'm going the wrong way here, Mr. Shortell. Let's talk about how to manage a note, okay? And we put a heavy emphasis on that, and that's our good old Mr. Loan Servicer, okay? So basically, if we do it right, he does the work for us, which means that they collect the payments, they manage the escrow of taxes and insurance, they're licensed and compliant, and any kind of borrower communication with the workout, they're really the one that does it. If an investor does that, then his payment goes to the servicer, and the servicer then forwards the payment on to the note owner. The good news is when that happens, I have a passive investment.
There you go.
And that's a significant factor in the deal. So these are all why we're real meticulous about all of these characteristics, is because I know at the end of the day what that investor really probably wants is to outsource a lot of the compliance, a lot of the legal aspects. He wants to be able to outsource it, okay? And what he really wants is this, that old magic easy button.
Yep. You've got the licensing issues covered, you've got the compliance, you've got the debt being collected and accounted for. Yeah, that's where that passivity comes in. That's what makes it easy.
Okay. What is the most common question a rookie investor asks when buying a note? You want to know what it is, Kevin?
I'm pretty clear what it is. I get asked a lot too.
You're saying my audience wants to know here, right? Is that what you're saying? What is my yield?
Yeah.
And the proper answer for us is, who are you? Because some investors don't need certain deals. And listen, there's deals that we won't buy, for sure. We see them all the time. And there are deals that we won't buy yet because it hadn't seasoned long enough. So we ask these same questions ourselves. But the more passive the investor, the more this is the case. So what I did, Kevin, is I kind of broke this into looking at this business. So you got institutions, and they have investment grade loans, which are Fannie Mae, Freddie Mac, FHA, institutional grade, which are a low yield, well underwritten, low risk deal, right? Like these are bank deals, right? These are super conservative insurance companies. That's the kind of stuff that they chase. Then you got private money. So you have private money that are passive investors, and they're really looking for a coupon clipper. And then you got private money that's an active investor, and they can be a more aggressive investor because of their knowledge and their tolerance. They generally want a higher yield, but here's the key to it, Kevin. They can manage the process. And the reality is they can manage the problems, okay? And then we've got this guy, Mr. Shortell, and that is the foolish investor. And that foolish investor is somebody that is drunk on yield and thinks they're passive, but will soon find out they're active. In other words, they bought something and they do not understand the element of risk they've taken.
just one quick example with going back to where you were talking about the 2 years, and somebody might buy that note at par, meaning they'll just buy full face value of the note because, heck, I'm making 9%. That's what the yield is on the note, and they buy it in that risk factor with no seasoning, and now all of a sudden they become an active investor because they've got problems.
Exactly. So that's where we place an emphasis on. Listen, we want to do lots of note business with people, right? We're in the note business in a fairly heavy way, okay? But we have a training business that teaches people the variables so that we can then do note business with them and that we all understand the same rules, right? When you don't understand the same rules, then all of a sudden, somebody stepped off in a pond, and it was full of crocodiles, and they just didn't know it. And we don't like that. So we're always trying to eliminate that factor in the note space. All right.
Yep. The yields are going to come down to your rules again, right? It's a combination of them.
So here's a question, Kevin. What rate of return do I get? What's my yield? How much interest do I earn per year? So let's take those 6 variables. And let's look at this. If I have a buyer with good credit and I have property that is bankable collateral and I have a buyer that has a strong down payment or has a strong equity and I got a note in a mortgage, okay, the secondary market, this is a pretty good deal, Kevin, right? I mean, you check yes in the blank. Good buyer, good property, strong down payment, strong documentation. The secondary market for this note is about 6 to 9%. And that's a pretty good deal, Kevin, because a 9% rate is probably about 12 or 15 times what you can get at the bank right now.
At least, yeah, that's an extremely healthy yield.
Pretty clear as to why somebody would want to buy a note, right? But this is a good deal, right? It's a quality note, and that quality note, that's what the secondary market is. So sometimes people think they're going to go buy this note, and they say, well, I'm thinking I'm going to get somewhere around 18% return. Well, would you show me where that well is? So we're just being realistic about what the secondary market is. Now, if you're us and you're out there in the marketplace all the time, and you can buy not one note but 100 notes and all kind of different variables, that this may be a different variable, but we're just saying for a single passive type investor that's going to go buy notes that are available in the market, this is kind of where they're going to stand. All right?
Sure.
Okay. So I got the next deal, which is what is my rate of return. Let's take the same 6 variables. I got a weak buyer. I've got not bankable collateral. I've got weak equity, but I have a solid 2-year pay history. Okay? So I got 3 weak variables, but what's my strong one? Okay?
Payment history.
I got a solid pay history, and I have unusual collateral, meaning that it doesn't look exactly perfectly like every bank loan, but it's a valid lien. Okay? Secondary market for that note is about 10 to 14%.
So a higher yield, it had some dings in it, but that's where you're kind of mentally taking that scale in your mind and weighing those things out.
Right. And this is the world that we live in. I mean, this is I'm throwing the pitch right down the middle of the plate. There ain't no curveballs here, right? This is exactly the world that we see every day, and that if every investor understood this is great. Now, who is this lady? Kevin, this is a little old lady in tennis shoes. And every real estate investor is looking for her because she is the lady that doesn't understand the rules and that'll take a wild shot on a deal that somebody shouldn't take. That's what. So when we're trying to sell, everybody's looking for her. Here's the reality. She don't exist. Okay? And so the reality is now I get into how notes are valued, and what we're starting to understand now is applying not just the science, although we'll continue to apply the science. We're now starting to apply the art. So if a note is written at a higher interest rate, naturally it's worth more money. I mean, I'm not going to buy a note as big of a discount, Kevin, that has a 9% interest rate than one that has a 5% interest rate, right? Because when I buy the right to assume the interest rate it's paying.
Mm-hmm.
So the higher the interest rate, the more the note's worth, and the higher the investment yield, the less the note's worth. Meaning that if I have a loan that has dings on it and the investment yield range is 10 to 14%, that discount in that note is more, meaning the note's worth less money. Let me show you an example. Here is an analogy that we did in the first one, Kevin, which is the longer term note, the greater the discount, right?
Right.
Here is a $100,000 note that I just calculated what a 9% return, annualized return, interest on your investment per year, okay? So I took a 30-year term, a 15-year term, and a 5-year term. Now, we'll all agree that long term they got to be able to make their payment, right? But just assuming there's some, you know, there's some, all the details line up and that they have that ability to pay, right?
Right.
The discount rate goes from 74 cents on the dollar, basically 74,513 on a $100,000 note. It drops to 83,000, or goes up to 83,000. And if you had a fully amortized 5-year note, then even at a 6% rate, it's still worth $93,000 on a $100,000 note. Basically 93 cents on the dollar.
Mm-hmm.
Okay? I'm going to change the numbers, and now I changed the return on my investment to 12%. Same terms, I just want a higher return than 9%. Look at the difference, Kevin. I'm only paying 58 cents on the dollar for a note that I was going to pay 75 cents on the dollar for. That's the first line here. That's the 30-year note, right?
Mm-hmm.
The second term, which is 15 years, I'm buying that note, and now I'm going to pay 70,000. I was going to pay like 84,000 for it, right?
Right, $14,000 difference essentially.
Now, the least discount difference is in the 5-year term. So the other one I was going to pay about 93,000, and now I'm going to pay almost 87,000. So the shorter term helped me, but you can see as the yield goes up on the investment, the discount goes up. So once again, the mathematical variable here that everybody has to equate into the investment they're making is okay, well, what's this deal worth? You know, and some deals are legitimately priced at a 9% yield, right? Because that's a fair yield for that investment. Right. Sometimes people show us deals and there's these elements of, you know, non-conformity that we've been talking about all through part 1 and part 2. And so we're going, no, it's not a 9% yield. We got to have a 12% yield on that deal. And when that's the case, the discount goes up. Same note, more discount.
Mm-hmm.
All right. Now let's change the formula a little bit, Kevin, and let's go to a 9% interest rate note.
Oh, you're taking a $100,000 note now, already written at 9%.
And we're saying, what if it is really has some great redeeming factors, and it's worth a 10% yield? Okay. So when you see that, there's not a lot of discount in this note, is there, Kevin?
Right.
I mean, even a 30-year note's at 91,000, a 15-year note is 94, and a 5-year note is 97,000 on a $100,000 note.
Mm-hmm.
So once again, it goes back into kind of equating the yield and the math of what, how you discount a note to the other life scenarios of pasting back all these things that influence discount. If we'd have just done the math lesson and we wouldn't have had any logic as to what kind of yield is fair for what kind of note you see, then once again, yeah, you would have learned the mechanics, the science of the math. It doesn't mean that you would have learned the art of the deal. Now, Kevin, I changed it. I went to a 14% return. Okay? So I'm going to buy a 30-year, 9% note. The first one at the very top is a 30-year term, and now I'm back to paying 68 cents on the dollar, right, even though it has a 9% interest rate.
Mm-hmm.
So, once again, people say, well, show me what a 14% note looks like. And Kevin, I know you, like in the classes and stuff, you give probably 80% of the class is really some form of a case study, right?
Sure.
So that they can see a real address and a real property, and we analyzed it. So there is a deeper dive into show me a scenario that a note was bought at a 14% yield, and the truth of the matter is, yeah, we do that. But I do need to understand the effect of the math, and that is, you see, the difference in term, 5 years, 15 years, 30 years, definitely influences the discount variables on a note.
Mm-hmm.
Pretty dramatically, right?
Absolutely.
All right. So, do you remember this movie, Kevin, called 10, back in the 70s?
I do.
Uh-huh. So I decided to call this little exercise "Getting to a 10."
All right.
So if you're a millennial and you haven't seen the movie, go. It's about a real pretty woman, and the guy refers to her as a 10 because she's perfect, right?
Right.
And it's not offensive or any. There's no intent of that whatsoever. So anyway,
how do we find the perfect deal or work towards it?
Exactly. How do you get to that 10? And so then how you do that is you get to enough redeeming factors. And I'm going back to some language, Kevin, I previously used, which is called fully baked.
Mm-hmm.
And now that it's starting to make sense that I buy imperfect deals, but there's a factor that I get to when I get to enough scenarios, then I start realizing that, okay, now I'm good enough, right? I may not, I can never make the deal perfect, but it can be good enough for me to buy, and that's what I refer to as being fully baked.
Gotcha.
Got it? All right, so we're back to the same old, boy, we've used this chart a lot, haven't we?
We have.
Just a lot of different applications to the same set of numbers, right? What we're doing here is we're trying to paste over deals over this grid so that you can start running this in your head, okay? So I got a weak buyer, I got a non-bankable property, I've got a weak down payment, all right? And that's a 1, that's a 3, and that's a 1. And now all of a sudden, if I have a very limited pay history, and let's just say that's a 0, Kevin.
Mm-hmm.
I haven't gotten to a 10, have I?
Have not. No.
Yeah.
Weaker note.
Exactly.
All those non-redeeming qualities.
Right. So now I take the same scenario and I say this pie basically isn't baked. It's not. It is. There's some unpredictable factors in this that I wouldn't want to buy it until it had more of a proven pay history. 3 months may not be good enough on this deal. All right. Now let's take the same chart, same variables, weak, non-bankable, weak down payment. Oh, well, same numbers, but this loan, Kevin, now has a 2-year solid pay history. Okay? Now I can give it a 5. Now, it has unusual documentation. You know, it could be like a land contract or something, right? Nothing wrong with it. It's a valid lien, absolutely, positively. Maybe that's not perfect, but now, because of the pay history, I'll add that to the equation, and it's a 2. And you run the math here, Kevin, and I think I'm at a 12.
Right. You found a 12. Better than a 10.
Yeah. So does that make sense? So the first one we looked at, because of the weak pay history, these other variables just aren't going to add up to that minimum score that I know I need. Then I look at this one, I say, here's your old fully baked pie.
Makes sense, because you're looking at the 6 rules and you're looking at the relationship. You're looking at each one of them, but then you're looking at the relationship between all of them and weighing those out between the redeeming and non-redeeming, and essentially you're putting a little score system to that makes sense. You go, yeah, this one's of a higher quality. This is something that makes sense.
And I'm going to tell you this, after 37 years of doing this, okay, and a squadron around here that has got maybe not 37 years experience, but a bunch. And I mean a bunch is in many, many zeros behind the number of loans, these type of notes that we've bought. We still, Kevin, discuss this stuff literally, if not on a daily basis, every day or two. And because this is the, you know, this is these are the loans that are out there and that are available and have a good return and are a phenomenal investment, and they do have some imperfections, but that doesn't mean they're all bad. Yet I see some people buying notes they don't need to be buying because the pie's not fully baked yet. and if they're in that unlucky 20% range, well, they're not good. And by the way, even the people that don't default, people that get delinquent and may stay chronically delinquent, that's another higher percentage on top of that. So this is why that we, in my mind, I can say, Kevin, and I watched you teach the other day, and you kept using a scale, you know, a teaching analogy, and you kept using that scale and adding to that scale.
Right.
And I think this is just how you and I think today, right?
Exactly.
I mean, everything that we do is kind of weighing these variables of the deal to kind of this ultimate scale of when do I have when can I get to that magic 10? It'd be great if I can get over 10, but when can I at least get to that 10?
Right, because you can't look at one variable and say that's it, and that's where, again, some people look at just that yield, and that's not it. That's not the whole thing. There's ITV, there's all these other variables, looking at these, weighing them out, and then, again, looking at what the industry provides and where the yields are and all that stuff to see if it makes sense. Exactly.
So Kevin and I discuss all the time bringing curriculum to you guys and just some good stuff that we want to, you know, show you in the market. They're all building blocks to take you deeper in the business. And Kevin, I know when you do the classes and stuff that really, you know, now that we have these building blocks, these real deals, these case studies that you break open and look at all these different dimensions of, every dimension on there you give a lot of examples with of what that looks like and why and stuff. And people say, well, why do you do all that? And it's like, well, you know, it's taking them on a tour of our business, right? We don't have to load up on a bus and ride around and look at a house. The cool thing about our business is if you can lean over Kevin's computer screen, lean over his shoulder and look at his computer screen, he can show you lots of deals. This one's buyable, this one's probably not buyable, so forth and so on. So this is good, solid building blocks that is going to help everybody progress in the business. in like understanding kind of where you stand as an investor and what that means. Or if you're, Kevin, if you're trying to broker notes, you got to understand what is an investor in the marketplace. How is he going to be measuring it? One thing I'm going to tell you, I know pretty much every institutional investor or every significant investor that buys seller finance notes. I mean, Kevin, you and I know them pretty well, and I don't know any of them that don't analyze a deal the way we've described it. I mean, this is how the industry works.
This is it. Exactly right. This is it. These are again, you always have in business and investments, there's these fundamental exercises and things that you need to know, and if you build upon these foundational things, I mean, they're consistent. Those will not change in the business. This is how the professionals do it, no question.
Yep. You guys are awesome. Thank you so much for attending. Kevin and I really have looked forward to teaching this. I spent... Kevin, a lot of times you build a curriculum. This was actually my curriculum.
It was. That's right.
And so we kind of split up duties, and I really enjoyed building this. I spent a lot of time actually doing it because I had to think through, kind of how we pull it together at the end, and keep showing you these same 6 characteristics, but keep showing you how they apply in the best way that we can. So I hope this was meaningful to you. We're always grateful and appreciate your feedback and hearing from you on it. And Kevin, we are going to say goodbye for now, but not for long. We'll have another little session here and have something really good coming up here pretty quick, and these guys will get a notice on that, right?
Look forward to it, and yes, they will. And thank you, everybody, once again.
All right. You guys have a wonderful day.